What's up guys, welcome back to the new video. I'm your host Yash from Equity Master, trying to make markets simpler for you. Thank you for tuning in every week. It means a lot. Before we move on, please note that this video is for information purposes only. It's not a stock recommendation and should not be treated as such. There's no opinion or view on any stock covered herein. With that disclaimer out of the way, let's get started. In today's video, I'm going to be talking about some high dividend yield small cap stocks. You see, the Indian small cap stocks have delivered remarkable returns for investors over the past few years. As these smaller companies have grown and expanded, they've created wealth by capitalizing on niche markets and emerging opportunities. With many small cap stocks significantly outperforming their large cap counterparts, they have drawn the attention of savvy investors. Among these, high dividend yield small cap stocks stand out as a unique category, offering not just the potential for capital appreciation but also steady income through dividends. As we approach the new year 2025, some of these companies are well positioned to deliver both value and reliability. So in this video, we'll explore the 5 high dividend yield small cap stocks that deserve a spot on your watch list. The first stock on this list is Power Grid InvIT. The company owns, constructs, operates, maintains and invests in power transmission assets in India. It is sponsored by Power Grid Corporation of India. It's also responsible for managing the InvIT, providing the initial portfolio assets and undertaking investment decisions related to its assets. At the current market price, the company's dividend yield stands at 13.7%. Power Grid InvIT registered with the market regulator as an InvIT on 7 January 2021. Since then, the company has paid consistent dividend to its shareholders. Here's a look at its dividend history. The company has high revenue stability due to the presence of transmission service agreements for 5 years with revenues linked to transmission system availability. The presence of CERC, which is sharing of interstate transmission charges and losses regulations 2020 for the collection of transmission charges, leads to higher cash flows and stability. This allows Power Grid InvIT to distribute consistent dividends to its shareholders. Despite its strong dividend history, the company has delivered poor sales and net profit growth over the last 3 years. It also has high interest rate risk for the debt availed, as the transmission charges are fixed in nature for the tenure of the TSA. However, the net debt to AUM remained lower at 0.26% as on 31st March 2024. This leaves sufficient headway for the InvIT to acquire new assets through debt funding. Moving on, the second stock on this list is Chennai Petroleum. Chennai Petroleum is involved in the business of refining crude oil to produce and supply various petroleum products and manufacture and sale of lubricant oil additives. Chennai Petroleum's dividend yield currently stands at 9.2%. Its 3-year average dividend payout is 14.6% and it has been consistently paying dividends since years. In the past 5 years, the company has reported only a 10% compounded annual growth rate in its revenue. Despite this, the company maintains strong financial health with an average ROE of 29% and ROCE of 23%. Chennai Petroleum is working on a 9 million ton per annum refinery at its Nagapattinam district through a joint venture with its parent company Indian Oil Corporation. The company is expected to invest about Rs 3,030 crores for its 25% stake in this project, which cost around Rs 36,350 crores. The refinery, with a capacity of 180,000 barrels per day, is projected to be operational by the end of 2027, marking a 2-year delay from the original target of 2025. The project cost has also been revised, with about 66% of this to be met through debt. Chennai Petroleum has pegged the previous cost at about Rs 29,400 crores. The company is also in discussion with banks to secure a substantial loan of $3.3 billion to support the construction of a major oil refinery in Tamil Nadu, India. Moving on, the third stock on our list is Procter & Gamble Health. The company is engaged in the business of manufacturing and marketing of pharmaceutical and chemicals. It is India's largest VMS company manufacturing and marketing vitamins, minerals and supplements. It has a strong portfolio of various brands such as Evion, Neurobion, 7Cs and Livogen, among others. In 2018, the company, which was erstwhile known as Merck, was acquired by Procter & Gamble Company of the USA as part of its global transition to acquire Merck KGa's international consumer healthcare business. This was done for a total of Rs $4.2 billion. P&G acquired 51.8% stake of Merck for Rs 1,300 crores. Procter & Gamble Health's current dividend yield stands at 4.6%. The company has been maintaining a healthy dividend payout of 110% over the past 3 years. Procter & Gamble Health has delivered a poor sales growth of 6.3% over the past 5 years. The company's net profit has also degrown by 24% on a CAGR basis. However, the company has strong return ratios. Its ROE and ROCE stand at 31% and 42% as of June 2024. It also has no debt on its book. The healthcare sector in India has undergone a significant transformation, fueled by substantial investments in infrastructural developments. Since 2016, the Indian healthcare industry has witnessed a consistent growth trajectory, boasting an impressive compounded annual growth rate of about 22%. The consumer healthcare sector shows promising prospects about the future. The company is well positioned to sustain and strengthen its position in the market. Moving on, the fourth stock on this list is PTC India. The company is in the business of power trading business. It is promoted by Power Grid Corporation of India, NTPC and Power Finance Corporation and NHPC Limited. PTC India undertakes trading activities which include long-term trading of power generated from large power projects as well as short-term trading arising as a result of supply and demand mismatches. It's also a co-promoter of India's first electricity exchange and does cross-border trade with Nepal, Bhutan and Bangladesh. PTC India has a dividend yield of 4.4%. The company has paid dividends consistently since 2002 and has been maintaining a healthy dividend payout of 49% over the past 3 years. The company's financial performance, however, has been muted over the last 5 years. Its sales have grown at a CAGR of 2% while net profit has grown at 3%. However, the company's management remains optimistic about the power trading business despite some challenges in demand and weather conditions. It is expecting better performance in the upcoming quarters if the monsoon is favorable and generation from its hydro plants increases. It remains optimistic about its financial performance in the second half of the financial year, stating no headwinds are anticipated. The company has also signed a definitive agreement for the sale of PTC Energy Limited to ONGC Green Limited with closure expected by mid-December 2024. The company has also reassured that divestment considerations for PTC India Financial Services will be revisited post the PEL transaction. The company aims to maintain a balance of mixed long-term and short-term contracts, targeting a growth rate of 6 to 7% in line with the national trends. PTC India is also planning on diversifying products and exploring new markets, including imports from Bhutan and Nepal. Moving on, the last stock on this list is VST Industries. VST Industries is engaged in the manufacturing and trade of cigarettes, tobacco and tobacco products. The company is the third largest player in the domestic cigarette market with a significant presence in West Bengal, Andhra Pradesh, Telangana, Bihar and UP with 8% market share based on volume. VST Industries' cigarette brand Total is among the top 10 brands in the industry. VST Industries has a dividend yield of 4.1%. The company has been paying consistent dividends since the year 1997. However, the company has delivered a poor sales growth of 5% over the past 5 years, which was impacted by sluggish rural demand. Its net profit has also grown at a slower pace of 6% on account of higher share of low-margin tobacco segment, increasing tobacco cost prices, and higher packaging costs. Though key raw material prices continue to be abnormally high, the company is rationalizing its cost structures and placing great emphasis on innovation and digitization to improve its margins going forward. The company's return ratios also stand strong, with return on capital employed and return on equity at 32% and 25% respectively as of financial year 2024. VST Industries' balance sheet is also debt-free. So there you go. These were the 5 high dividend yield small cap stocks for your 2025 watch list. Indian small cap stocks have proven to be a rewarding avenue for investors seeking both growth and income. The 5 high dividend yield small cap stocks discussed here offer a blend of stable dividends and the potential for significant capital appreciation. However, while these stocks may seem promising, it's important to remember that small cap investments come with unique risks, including market volatility and liquidity concerns. By staying diligent and informed, investors can make the most of the opportunities arising from the high dividend yield small cap stocks and the opportunities that they present in 2025 and beyond. That's it for today, guys. Don't forget to like this video and share it with like-minded investors and make them smart as you are. Hope you have a good rest of the day, and I'll see you in the next video. For more details on this story, check out Ayesha Shetty's article with the link provided in description below. Happy investing!